Hey, good morning, traders and investors, and welcome back to the Wednesday Trading Analysis live stream show. I'm your host, Bennett Tyndall. We hope you're doing well today. We appreciate you all taking time out of your busy Wednesday mornings to join us. We got a big week in the markets. We had Microsoft and Alphabet, probably more commonly known as Google, both with a top and bottom line miss. Shares initially traded higher, a little consolidation, and then both shares of Microsoft and Alphabet rallied higher as their earnings calls got underway. The week continues. We've got the Fed decision today. We've got GDP and PCE later in the week. We also have Apple and Amazon set to report on Thursday. So a lot's happening. We've got a good show in store for you. Before we get started, before we get to the charts, we're going to bring in the trading analysis team. We've got company founder with us today, now Director of Investments for New Age Wealth. Good morning, Todd. Good morning, Terry. How are you doing, gentlemen?
Good morning, guys.
Good morning.
How's it going?
Doing well. How are you today?
You just picked up your head and the summer's half over, right? I mean, you have some summers that have low volatility and you get out and enjoy what the summer offers, and other times like you just trade right through. It seems to be one of those kind of summers, but all's well here.
Good.
All's well here. I know one guy in the trading analysis team who's out enjoying summer.
I was going to say, Alex is not with us today. He's enjoying some time off. I think he's getting some kite surfing in this morning. We'll see. Dude,
we've been asking him for pictures and videos, but he's unplugged. I can't wait to see Alex kite surfing.
Oh, absolutely, absolutely. What's up, Terry? How are things in your neck of the woods today?
Hey, like Todd said, man, summer's almost over. My daughter's taking summer physics class, and second session midterm test already passed. That's crazy. I mean, it just, she's going to be going to taking off for school here in a couple of weeks, getting her set up in a new apartment over in Houston. And
Nice.
Yep.
Nice.
Yeah,
That's awesome.
It's been a busy summer. And I think things will continue to remain interesting, especially with some 160 plus S&P companies set to report or have already reported this week. Anything specific that you guys would like me to cover stock-wise or sector or index-wise before we jump into the charts?
Was that for us or for the attendees?
For both. For both.
Well, I mean, you and I had a good conversation yesterday. Running the wealth management business, the whole idea was to launch the wealth management and kind of be the next step where trading analysis was. And I rely on the guys' content and analysis quite a bit. And Bennett and I had a great discussion, and that sort of helps me allocate the portfolios and know what stocks or sectors or industries to overweight, underweight. And Bennett and I went at it in a great way yesterday in the technology sector, and we're just looking at the different industries that make up tech, and I think there was a pretty clear takeaway in semis in terms of the technical position, but also the fundamentals as well. Semis are looking good, and then I think 2 weeks ago we had the discussion, and I think Terry and I were going back and forth, and I posed this, I think, on the show, what a small percent of tech semis actually represent. I was shocked, Terry. I think it was like 15 or 17%. Is that correct? What we came up with?
I don't remember the percentage, but it is one of the subgroups that does seem to affect the XLK quite heavily, despite its low market cap. So,
yeah. So you're looking at hardware, which Apple's actually doing well. Software. I mean, there's a lot more that represents tech, but semis were certainly interesting in there, and just trying to decipher the wave counts. Where in terms of this kind of rotation back into growth led by tech. You look at the wave counts, you look at the technicals, you look at the underlying sentiment, you look at the fundamentals as we're starting to get the data coming out, and it's an interesting market here. There's a lot of cross currents in here, so I think it's really important just to stay nimble, stay flexible. But Ben, I was just that conversation stuck on my mind in terms of you and I going back and forth on tech. I'm going to hit some consumer discretionary when I'm up. Some interesting sort of retailer data that I was going to throw in front of you, which is counter to what the prevailing market sentiment is. So, and what the accepted, position of retailers are in this inflationary bit. So, yeah, just a couple random opening thoughts there.
Sounds good. Appreciate it. Yeah, I'll take a look at the chart of the SMH. I think there are some fairly key developments taking place in that particular industry group. And back to the weighting in tech, I think it was right at about 20%. But either way, not what one would have anticipated given the significance of that particular group.
Yep.
All right, so let's hit it. I'm going to take you in the hard right edge. We're going to hit the MotiveWave platform, and I'll take you through WTI crude oil. We will also take a quick look at the dollar and gold since Alex is not with us today, and then I'll take you through the indexes. So, gentlemen, back in just a couple of minutes. Hey, good morning, traders and investors. We appreciate it. Thanks again for tuning in. Let's hit it. Hard right edge of the MotiveWave platform. We're going to go full screen, taking a look quickly at price action in WTI crude oil. And if you caught my recent market update on YouTube, this was posted last week. We talked about this particular wave count kind of in detail, taking you through some traditional technical levels as well as the overall Elliott wave count. I think the bigger takeaway is that I continue to view the move from the 130 handle high in March as a counter-trend corrective consolidation that should ultimately yield continuation higher. And a move back to and a knock on the door of the 2008 146 handle high, I feel at this point is imminent unless this overall trend breaks significantly lower. So let's go ahead and get off of the weekly. We'll take a look at the daily time frame, and zooming in on the daily time frame, we have been tracking this kind of sideways to lower consolidation, which takes you back to the March high. And in our public market update from last week, we discussed how the overall wave count from the March COVID low specific to WTI crude oil is a bit subjective. And as a result, there are multiple valid Elliott wave counts. And so what we opted to do in that video update is use some confirming momentum indicators. We used RSI, we used volume, and both of those particular indicators helped to substantiate the view that, in fact, the March high was some sort of a wave 3 position with consolidation here in wave 4. So what I'm watching here now is trendline support, which takes us back from November of 20 through November of 21, which, zooming in here on the one-day time frame, we can see a move down in a 3 back in B to the 786 retracement, and we ultimately found support just shy of a quality of wave C compared to wave A. So looking at the confluence of now Fibonacci and trendline support, we have seen a bit of a response back to the upside, and we're tracking signs that this could actually be upside reversal out of consolidation. Now, I mentioned in the update last week that a break south of the low from July 14th would not invalidate the overall wave 4 position. That would simply invalidate the idea that wave 4 is complete. Over to the dollar index, you all know we've continued to look higher following the wave 4 completion, which occurred in January of last year. If you look at this particular trend going back to 2008, we have an initial 5-wave move up, a consolidation in wave 2. You've got 5 smaller waves of green 3. Within green 3, orange 3 was 1618, orange 4 was 38%, and orange 5 was about equal to wave number 1. From there, you'll notice we met resistance at the higher degree 1618, and then we have this consolidation, which ultimately was about 161% of time elapsed in wave 2. Looking at the move currently, we are now challenging technical resistance in the form of our base trend channel from 2008 through the 2011 low, with our wave 3 high acting as the upper boundary. And we're also up against the 786 retracement of the decline from the 2001 high in the dollar. Now we continue to look higher, and we actually have a zone of fib up near 112 that we are watching. Not quite sure if this is 1-2 of orange 5, but the bigger takeaway that we looked at last week was that we continue to look higher before this overall trend comes to completion. Taking a look at price action in gold, I put out a video on this yesterday. I'm actually seeing a zone of support on the horizon for gold futures and precious metals in general, silver included, that could yield upside reversal. The move in March to 2078 we deemed to be a corrective high. Once we had an initial 1-2 off of the top, we actually took a short position with our clients back here on April 19th. But now that we're approaching the completion of this 5-wave decline, we have to ask ourselves the question as to whether or not this orange wave 4 is truly going to complete as a flat, or if this is going to morph into a complex. And for those of you who are new to Elliott Wave, what that means is from the 2078 high into support, the flat correction would call for the trend to finish lower in 5 waves. Or alternatively, if it is some sort of a complex development, then this would call for a completion in 3 waves, meaning once the 5-wave decline completes, we'll be looking for either 3 or 5 waves back to the upside. Now, I'll quickly take you down to the 195-minute time frame, and here on the 195, what we're looking at is the final subdivision of what is green C of orange wave 4 over here on the weekly. You'll notice the base trend channel, which offered resistance in blue wave 3, August of 2019. Down to the 195, we've been tracking an extended wave 5, so that green wave 5 that we showed you there on the weekly, which is part of blue C of orange wave 4, that extended 5th wave, we had been tracking with a downside objective near 1678 to 1680. We met the 1678 target. We've seen a pretty decent bounce back to the upside. Now you see this green trend line. That green trend line represents the upper boundary of our base trend channel. So now that we've broken south of that base trend channel, which by the way has gone from resistance to about support in the A wave here, now that we've broken south of the upper boundary of that base trend channel, I would expect the first retest of it to yield another move to the downside. And that's exactly what this wave count suggests. This wave count suggests 1744 to 1749 resistance could take us back to 1650 to 1672. So that's what we're watching in gold. Now let me take you over to the US market indexes. We're going to start it off looking at what is our red count. And as we discussed last week, the only difference between our red count and our blue count, because the entire team remains bullish in the higher degree of trend, meaning we expect this 7-month plus consolidation to resolve higher. The only difference between our red and our blue count is our blue count would suggest that in the complex corrective structure, going back to the January 4th high, that we have a completed WXY, meaning 3 down of W, 3 up of X, 3 down of Y, with markets completing the correction June 17th. If this is the case, we could see the first sign of a truly confirmed trend reversal following today's Fed decision. I'll take you kind of lower in the time frame scale here in a minute. And then alternatively, as we looked at, and we can't yet dismiss as a possibility, markets still have one final push south towards 3,400 to 3,600 area support. Even if this wave count unfolds, we would be looking at that as a buying opportunity. So now what we need to do is dissect lower in the time frame scale, down off the 195, down to the 1 hour, what actually happened in the trend from June 17th. And I got to admit, while we do have some fairly bullish motive trend establishing price action in semiconductors, there is a argument to be made that this was simply a 3-wave measured move rally. I want you to notice the wave blue C came just shy of being equal to the wave blue A. Said otherwise, the June 17th, the July 14th through July 22nd rally was equal to what we saw from June 17th through June 28th. That equality level was 40.37. The high was 40.12, spot 4.4. And I also want you to notice the time measurement. We know corrective legs of the same degree will often tend towards equality. So we basically met equality of price and time at nearly the exact same candle. This appears to be a very symmetrical correction, but this could also be upside reversal, meaning from the low, instead of this being ABC up, we actually have a series of 1-2, 1-2s. And if this is truly a series of 1-2, 1-2s, we're going to be looking to confirm that with our clients today and into tomorrow following the Fed decision. And if we see the signs that we need to get after this, could be a very bullish pivot into the remainder of the quarter. And then if markets for some reason are met with a hawkish surprise today in light of the August break, perhaps we do have additional downside left to go. If markets continue to move lower, I would be focusing primarily on the wave count that you see here in front of you. Now, that's the S&P. If we take a look at the NASDAQ, the retracement of the decline that we have here from June 2nd through June 17th has been fairly significant. In the case of the NASDAQ 100, we exceeded the 786 retracement. So while it's technically possible that this too was simply an ABC rally, it's looking more likely probabilities are shifting in favor of the corrective trend having come to completion. We're going to take this one wave at a time and continue to update you as things develop. So that's the NASDAQ and the S&P. Before we take a look at the SMH and wrap up, let me just take a quick look at the chart of Russell 2000 small caps. Here in the chart of Russell 2000 small caps, as we've been discussing kind of the characteristics associated with corrective waves recently here on the show, I thought it would be a good opportunity to use this chart to illustrate that very point. And what we find in regards to corrective legs of the same degree is, as mentioned, they often tend towards equality, and they will also often stage support into their corrective trend channels. Corrective trend channels simply take in the origin, so the start, the high that was before the beginning of the downtrend, and that in this case for small caps was November 5th. So taking a look at the origin, we take the origin through our X wave, we then project our parallel trend line over our wave W in this case, or wave A, and I want you to notice that is exactly where we staged support on May 12th, and that's also where we met support here on June 17th. In addition to that, if we take a look at the magnitude of the initial November through January 28th decline, we measured that, we project from our X wave, equality came in at 1635.60. The actual low in the rut has been 1641.58. So we met equality in price, and guess what? We did so. I don't know the keystrokes for the combinations. I thought I did. The price equality was met into time equality, meaning from the X wave, wave Y said 1635 by June 16th. We got 1635 by June 16th. You can see our color coordinated fib levels here in the trading analysis edition of MotiveWave. So small caps, semiconductors suggest that the low is in. The S&P and the NASDAQ still have very symmetrical looking three-wave rallies for the time being. So we're going to continue to approach this trend with caution and take it one wave at a time. So that's it from me. Let's take a look at the SMH and we'll go from there. If you didn't catch my video update in the SMH, same situation here. We have 5 down, 3 back, another 5-wave move down. Every time we met the corrective trend channel, we used it as support for a bounce back to the upside, unlike the S&P and the NASDAQ, where they actually broke south of their corrective trend channels. And then, my goodness, looking at this trend off of the low, we have trend line resistance from the March high through the high here in June. And you'll notice we got above that. We're consolidating. Wave 3 in this instance was about 161% of 1. This is very typical of a motive development and not so typical of a corrective rally. So trends continue to remain mixed. We overall continue to remain optimistic and bullish, even if markets do probe lower down to the 34 to 3600 S&P target. That's it for me. We'll get the screen set up here. Terry's going to take you through Optima. Any thoughts, gentlemen?
Yeah, it's tough. I mean, you look at the NASDAQ just ever since we kind of crashed into those May lows and just deciphering from a technical point of view what that is. I mean, sometimes, I always tell the guys it's important to just kind of step back. Sometimes, hit control up and down arrow, which is a shortcut on the keyboard for MotiveWave, take the labels and everything off and just step back and say, what is it? And it's just a mess. I mean, could it be just summer consolidation? Like we opened up saying how busy the summer was, but sometimes you have to kind of separate the pace and quantity of the news flow from what's actually happening in the market. And it's been flat since May. So are we reading too much into it? I don't know. What do you think, Bennett? What do you think, Terry?
I mean, that's momentum, right? That's the downward momentum has slowed dramatically in the markets. The markets, like you said, in the larger term, you started to see them move sideways. And, that's the whole name of the game. So now, when we say the markets move sideways, we're just talking about the indexes. So let me take you through the sectors here, and we'll show you which sectors are actually gaining momentum. And you've seen a lot of the sectors been losing momentum. And the sectors that were losing momentum are the ones that have been in the lead. okay? That past tense, have been in the lead. So let's see where we're going next.
Sounds good. Terry, take it away. He's going to take you through Optima, and we'll catch you on the other side.
All right. Hello, traders and investors. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So earnings season is now in full swing. We heard from Microsoft and Google last night, both reporting misses, but then did you see that their price action was moving higher in after hours action? I guess following the announcement that more information came out about forward-looking guidance that must have been positive. Markets must be liking what they've been seeing. Now, last week we saw rally across the board. Today we have the Fed rate decision looming ahead. Now, the markets have behaved quietly these past couple of days in anticipation of that announcement. Now, also, I think tomorrow is the second quarter GDP results. I was talking to Todd a while ago, and I thought it was interesting that the Fed announcement comes out ahead of the day of the GDP. So will that be a signal or what? Will we have another quarter of negative growth or not? Anyway, let's take a look here at last week's sector performance. Now, gaining 2.55% last week, the S&P has moved back above those May lows. And it's now challenging that psychological 4,000 level. And we haven't really mentioned that, but I think that 4,000 level is on a lot of people's minds as we came right up and just about nailed it and then peeled back here on Monday and Tuesday's trading. Now, last week's rally in the NDX was even more impressive as it actually rallied up 5.3% through Thursday. And even with Friday's pullback, it still netted a 3.45% weekly gain. Now that's nearly a whole percentage point higher than the S&P. Looking over here at the sector performance, last week it was the consumer discretionary sector dramatically outperforming all the other sectors, coming in with a 6.84% gain on the week. Materials and industrial sectors also found legs with better than 4% gains each, and energy was in the middle of the pack last week, gaining 3.73%. And technology sector right here, right behind the energy sector, up 3.66%. Now the worst performance came from utilities and healthcare sectors, though they were only marginally negative on the week. So this week, the indexes are retracing. We can see that here. The indexes are retracing some of last week's upside move. At the close yesterday, the S&P was down 1% from last Friday's close. The NDX has given back 2.5% of that 3.45% gain. Now, of course, the energy sector is once again leading the sectors higher. Let's pull this little table out and take a look at real-time data here. We're up 3.33%, including this morning's price action. My graph over here includes yesterday's data. So we've got energy up 3.3%, utilities is up almost 2%, healthcare, this is the only sector still holding out in the leading quadrant, is up 1.43%. And to the downside, our growth sectors are down now. That consumer discretionary, again, coming off a 6.84% gain last week, giving back 2.4%. That's volatility, but that's certainly not giving back a huge amount of that strength. Communications and technology down 0.8 and 0.5% so far this week, and we'll see where that goes. Let's go on over here to our relative strength sector leader scoreboard. Now, the energy sector continues to descend further here into the weakening quadrant, and though its momentum has fallen significantly, it still retains a high relative strength ratio, which could continue to drive price performance in the energy stock if momentum returns here to the sector. Now, like I said, the healthcare sector is now well, it was, as of last Friday, totally alone in the leading quadrant. Look what's happened here with Monday and Tuesday's price action added in. This last little vector, as I'm animating, is actually showing the healthcare sector wanting to exit the leading quadrant. So that leaves a gap. There's nobody up here in the leading quadrant right now. All the former leaders have pushed down into the weakening quadrant. Utilities, staples, materials, and industrials are down here in the weakening quadrant. Interestingly, the real estate sector's now got a blue hook forming here. So the real estate sector, let me just animate and pull this back here for a while. I'm going to take you back up to where the turn happened here in real estate. We'll just zoom in there. You can see that hook formed about the week of May 6th, and we got a reversal of momentum. And from that point right there, we've seen the real estate sector continue to push down. It got right here to the edge of crossing over into the lagging quadrant and then started to show us a hook. And now as we animate that hook a little bit further, we see we are in the lagging quadrant with real estate, but we've got a northwesterly vector. The vector is turned blue, which tells me price action on the weekly time scale in the XLRE is actually positive compared to most of these others here. At the same time, let me pull this back one more time here and show you that the technology sector as of last Friday, it actually finally turned blue. Now, that one had been on a long rotation out of favor also. It'd been more than a year since we've seen technology wanting to become a leading sector. And so with this color change back to blue, that also tells me we have improving price action there. Now, it has switched back to red, including Monday and Tuesday's price action. So we're on that precipice of change, right? We're in a big, this is the whole thing about sector rotation. It is the changing of the guard, okay? So the old leaders are fading out, and then we have new leaders coming back in. Financials kind of still lagging over here. We actually thought financials was looking pretty good a few weeks ago, say the end of June, right, with some rising momentum, but that momentum is drawn off, and we actually seen continued fade there in relative strength for that stock or that sector. So still holding out that we get some kind of turn in the XLF, but you can see how short the 4-week tail is compared to the rest of them. We have upward momentum here in technology. We have dramatic upward momentum now in the consumer discretionary sector. So you can see the consumer discretionary sector has pushed up into the improving quadrant, and the links of those line segments are indicative of the velocity of how rapidly it's gaining momentum and relative strength. Now, the communication sector, again, we'll see how it processes the remainder of Google's earnings report, and if we get finally get that hook and back to the northeast here in communications, we might have something to go. But for now, kind of communications wants to hang out here still in the improving quadrant. So again, high relative strength and energy, but we're losing dramatically momentum in all the former leaders, and now we've got a new set of leaders that we need to start taking a look at. All right, that's all I've got for now. Back to you, Bennett.
Much appreciated. Thank you, Terry. Big move up there for consumer discretionary. It's always interesting to see the difference in length of tails when seeing the rotations either in or out of various quadrants.
Right.
We'll see if communications...
Hopefully, Todd, this feeds into your discussion. You're going to talk some more about some consumer discretionary stocks.
Yeah, it's so interesting. It really does. You know, it's this earnings season. They're saying it's all about the consumer, and can the consumer continue to hold up under these inflationary pressures? I was reading through the Walmart report, and they were saying that they warned after earnings in May that inventories were growing quite significantly in the kind of stuff inventory that was in demand during the pandemic, right? So that's like at home. I think they were saying at home leisure wear, right? Some at home consumer electronics, and they're having to cut the price of that because of the overhang inventory, but also the elasticity of demand as prices are elevated. People are going to buy less of it because obviously food inflation are up, and food and energy from inflation are up. So we're just watching this consumer discretionary sector and what kind of products that retailers are selling are, some prices are being cut, which obviously is not inflationary. That would be disinflationary or deflationary. But it's interesting that the consumer discretionary sector, as you pointed out, Terry, is rotating into favor now as everyone is telling us to expect earnings revisions based on a weakening consumer, right? So, I mean, if you step back and think about that, like something doesn't square up there, right? I mean, has that thought come across you guys on that at all?
I think part of it is that the unemployment levels are still really low, 3.6% unemployment. I mean, it used to be we were in this kind of position, and you're going to get a weakening consumer. That's when you're talking, 4.7 to 5% unemployment, and
Sure.
People don't have money to feed themselves. They're going to stop buying discretionary items. I just don't think that the economy is actually in that position right now. The labor market,
right.
That is.
Yeah, I mean, it's hard to go into a session with 3.5% unemployment and wages going up, and certainly have wage pressure on the inflation side. We'll see. If it's a negative GDP print. I think right now expectations are positive, but also I think the general consensus. There's two things that are driving the market here. Is like, okay, we're going. I think the terminal Fed fund rate is 3.5 to 3.75. Whether we go 100 basis points now and 50 next time or 75 and 75, it doesn't really matter. I think the market has accepted that fate. It's we're headed there anyway. I was making another point, Terry, and I kind of got off track there. But I think. I mean, anyways, let me roll into kind of where I was going on the consumer discretionary side. I have sort of moved into a heavier position in the portfolios, and I'll show you guys this. Ben, if you want to throw over the screen, guys, I don't know, keep your microphones on. I'd love to get your feedback on this one.
If you could grab the GTM share, we just sent your direction.
Yeah. Oh, perfect. Thank you. New interface as always.
Yeah, they seem to switch it up like every 6 months, so I hear that.
I know. Who owns them now? Do we know?
I'm not sure. I forget. We did look into that, though. All right. Take it away, sir. Screen is yours.
All right. So as Terry was mentioning, I'm going to actually show you the weightings in two of the portfolios that we run for New Age. And consumer discretionary is the one that, Terry set up really well. And I actually increased the exposure to consumer discretionary after we just rebalanced here on July 20th. So this is the growth portfolio. Right now we have a 17. When we set up the reallocation, we had about 17.75% allocation in consumer discretionary, which compared to the last rebalance, which is in May, increased by 3%. And I benchmark the growth portfolio to the NASDAQ. So if you look at consumer discretionary weighting within the NASDAQ, it's 16.3. So we're actually overweight consumer discretionary in the growth portfolio. And then if you get down to the dividend portfolio, which we call tactical dividend, the same thing. We also increased the weighting in consumer discretionary 9%, adjusted up 1.75, which is still slightly underweight consumer discretionary weighting in the S&P, and there's the bell. So, one thing I wanted to throw in front of you guys, which I find interesting, kind of following up in this conversation that, with earnings, we're watching about revisions and the strength of the economy, the strength of the consumer with these inflationary pressures and their shifting demands coming out of the pandemic. If you do, and this is going to slow down big time because the bell just opened or the bell just rang and Optima quotes kind of really lag here as we go into the open. But if you look at the industries broken down, and this is probably just frozen now. Anyways, I'll try to describe this. I was hoping to get in before the bell rang. If you look at some of the industries that are rotating into favor, specifically their retailers and some of the on a week over week basis, the ones that are coming into favor are names like industries like specialty retailers, broadline retailers, apparels, non-durable products, clothing. So, you have a pretty interesting move in from a monthly situation, which this is lagging on the monthly, which means month over month over month, these guys have been in trouble. But just over the last 5 to 6 to 7 weeks, in the face of this this earnings, with the downgrades and the earnings revisions coming up for the next quarter, we're seeing some pretty good strength in the retailers, which I find interesting. It looks like Optima is just frozen for me in general, so this might be a shorter segment than I expected. Yeah, Bennett, is that coming through right now or no?
Yeah, we've got the screen, but there aren't any changes rolling through it.
Frozen. Awesome. All right, that's fine. So I was going to take you through a couple names, and one of the names I was going to look at was Amazon, actually. And Amazon, and if you look at this chart, is Optima froze for me. But if you look at Amazon relative to the S&P, this is just a daily chart, and this is just a simple Amazon into the S&P ratio. Amazon's been underperforming the S&P for like a year and a half. So they had some logistical issues and warehouse issues. They had some hiring. They overhired, and they've been underperforming the market for a long period of time. And just as soon as everyone's kind of throwing their hands up on Amazon, you could see in May relative to the S&P, you're starting to see the ratio move up. So Amazon sort of low, I think, has been formed as we're heading into, I think, what the market's about to discover, which the consumer is not in such bad shape because, again, the markets are rotating in. We all believe that the markets rotate and discount moves that will be reported in the news later. So if we look at some of the other kind of things I was going to throw at you guys here, this is a chart of the kind of the state of the consumer, right? And there's a few things going on here. So in purple, this is the retail sales year-over-year percent change. So let me just scroll this up so you can see the axis here. Okay, so this is going back into actually 2019. You can see retail sales in purple has actually been increasing, right? Blue right here is disposable personal income. So their disposable income has been dropping, the consumer down around 3%, but also personal savings has been dropping pretty significantly, while consumer sentiment here in green is dropping very, very sharply. Now we have University of Michigan coming up, I think it's Friday. And that's coming off 2 readings ago. It was like the lowest in its 72-year history, which is absolutely insane. So you have a consumer that is from a morale point of view is the worst ever. You have savings rate, which is dropping. You have real disposable personal income also dropping, but yet you have retail sales going up. Is the consumer sort of starting to spend some of that savings that they've been building up? Are they truly shifting, their tastes away? Is it really just focused on fuel and food and that's it? Or maybe is this earnings season going to be and show that it's actually not as bad as we had expected in the market? Again, the rotation that we saw in those industries are starting to sort of suggest that might be the case. So I'm a little bit more bullish, I think, than probably Bennett is. I think Bennett is, I don't know, trying to read between the lines. I've known you for a long time, man. I think you're willing and ready for the market to go in either direction. I think the overall, I would say the community of market analysts out there, I'd say, are probably 80% bearish. And if you guys disagree with that, let me know. So I'm actually starting to think, if you look at, the numbers out of Google, right? If you look at Google and the big thing that they were looking at was YouTube advertising. And, they were looking for a pretty significant drop coming from Snap. So Snap reported that stock has been absolutely getting crushed. I can pull that chart up real quick on charts that are not frozen. You look at the chart of Snap. I mean, that company's got real fundamental problems. And I think the market was discounting that big internet advertisers like Google, like Facebook, and Meta are going to be under significant pressure. This company is in a much different situation. You look at Google. I mean, that stock looks like it's hanging on for dear life above this shelf right here. But if you look at those YouTube advertising numbers, I think they're like 7 billion, right? Let me just look at this real quick. They really weren't as bad as people thought they were going to be. YouTube's ad revenue grew 4.8% in Q2. Analysts had forecast YouTube ad increase spending 7% to $7.49 billion. They came up to 7 billion, which is not meeting expectations, but still it's a pretty significant growth metric. And I think that's going to set up, as I said, Meta is going to be very interesting. And again, a consumer discretionary stock that's come up off the lows. We actually increased our exposure to Meta, probably a very unpopular move. But I think if you look inside of the Alphabet numbers, they really weren't that bad. 69 billion in revenue, up 13%. And they were looking for 69.99, and they did 69.69. So it's still pretty strong data. And again, we have to see advertising data is going to be sort of a leading indicator to the health of the consumer, which again, we were talking about some of the outperformance in consumer-oriented industries, which is leading into consumer discretionary and technology. And again, we increased exposure to both. So I'm starting to kind of be a little bit more encouraged. Let's take a look at commodities. Bennett did a nice job taking you through gold and crude. And I wanted to take you through a couple of the names that are really moving here. So I like to start off with, and this should update the chart. So this is on the Bloomberg Commodity Index. So I think forever, guys, we used to watch the CRB, just like the CRB index, and that got bought and sold a couple times. Hard to get good, reliable data on that. So I'm watching now the Bloomberg Commodity Index futures. Okay, so this is coming from June of 22. We dropped down here into July. This has been the bounce, pretty feeble, I would say. I think that looks like sort of a corrective bear flag. So that's the overall commodity index. A couple that have been strong off the bat are meat, okay? Cattle, lean hogs. Actually, lean hogs, that doesn't look good. Feeder cattle has been good, and actually spoke to a client in Texas, and he gave me some very interesting behind-the-scenes info about why cattle prices have been so strong, a lot to do with the heat and their food source. But then if we keep moving, I mean, you look at cotton. Cotton has come off big time. Coffee, not so much, but downtrend. Wheat has come off big time. Corn has come off big time. Cocoa, come off. Soybeans have come off. Sugar has come off. Gold, we did that one. Bennett did that. Here's crude oil, has come off. Natty gas continues to be very strong. Look at lumber, crushed. Gasoline is also going to be actually nowhere near as bad. Gas doesn't even look that bad coming off the 315. So, a lot of these inflationary commodity moves that earnings reports are citing in here have come off, and they've come off in the last month. And I think that's going to carry through into next quarter's earnings. And I think the market's going to start to look ahead of that. If you look at the tips, okay, you look at where markets are pricing inflation. So this is where markets are pricing inflation 5 years out. Back here in April, we were 5 years out looking for over 3.5% inflation. That's come off from 3.5 down to 2.5. I mean, that dropped by 33% in just about a month or two. That's a big move down in inflation. So I think that we're to the point where commodity related input costs, I think we can all agree that they've come off. Inflation expectations have come off. We need to get supply chains continue to loosen up, but Walmart did in their And the earnings reports say that, they are building inventories because supply chains are coming up. And then I think on the tech side, we have to figure out what Congress does with this CHIPS bill. Can American semiconductors compete with the likes of Taiwan? And you look at TSM, look at the relative strength of TSM compared to the NASDAQ. This thing topped back in February 21. Okay. Taiwan has come off pretty significantly. And if you focus, let's look at NVIDIA, for example. NVIDIA topped out in November. Okay, and TSM way back here in early 21. I'm almost wondering if the markets are pricing in that the 50 billion chips bill is going to go through, and perhaps American semis can become competitive with the likes of Taiwan. And it's certainly not an Apple slowdown issue. I love that NVIDIA chart, by the way, and I increased holdings in NVIDIA. Look at Apple relative to the NASDAQ. I mean, just right up on the highs. Relative strength point of view to the NASDAQ up in the highs. I even think, that's the S&P. Let me go to the NASDAQ. To the NASDAQ, we're right at the highs. Okay, so it's not an Apple slowdown story out of Taiwan. I think there might be something else going on there. So I just want to throw that one at you. Another name that's energy related. Actually, let me just mention this too. Terry showed that energy has come off quite a bit, and I warned investors that we would be cutting energy exposure, and we did that. So let me just bring over this in the dividend portfolio. We actually cut energy in half. So we cut our energy exposure, which we've had since October. We cut it by 4.75, and we're allocated 4.75 now. So we're actually just at slightly under market weight relative to the S&P at 4.9. And in the growth portfolio, I cut it by 5%. So at one point we were at 12.5% energy allocation in growth. Now we're still high. We're at 7.25, but we're considerably off where we were. And actually, the NASDAQ 100 has no energy exposure, which I find interesting. So we've cut energy pretty significantly, and crude oil, is it going to pull back? Has it pulled back? Yes. And I feel like this 100 level is acting pretty interesting. So, I'm happy to sort of take some profits in those names and move on. One that I would draw your attention to, which is a sort of an alternative energy solar storage, is Enphase. They manage solar generation, storage, communication. They just came out with earnings. They beat expectations. They had 77 million or 54 cents a share, compared to like 39 million, 28 cents a share in the last quarter. Like unbelievable beat. So they made $1.07 a share, and FactSet was looking for 85 cents a share. So revenues of 508 million, expectation 316. So Enphase just blew the doors off. From a technical point of view, one of the common setups I like to see is if you get through the retracement, specifically the 78% retracement of a prior trend, it usually indicates that you're going to highs and beyond the highs. And in the gap up this morning, we just broke through an Enphase. So we just broke through the 786 at 232. I hope I can see that small font there. So watch Enphase on the upside. That's a holding in our portfolio, and I'm going to actually look to add to that. But there's other names on the retail side, as I mentioned in the beginning, and I had it set up for you, but Optima froze on me. That we've added. We did actually add some Lululemon back to the portfolio. I think that's looking good. Increased Amazon a little bit. And let me just give you some other names here. Still like Tractor Supply, holding that one. And I haven't given up on Ford on some of the auto names. I think Ford has got a big backlog coming up. We've pulled off quite a bit in Ford, and I think that one might come back. So that consumer discretionary rotation back in, I think, is real. And I'm really interested to see how these earnings reports go and what CEOs say about guidance for next quarter. All right, guys, I'll turn it back to you.
Very good. Much appreciated, Todd. As always, taking a look at Ford, we have seen a nice move off of the low from July 5th. Also tracking that is as another potential trend establishing wave. So good move up there. I love Enphase, the sideways consolidation there. We were looking at that with clients last week, and nice sideways consolidation, little 5-wave rally up, 3 waves back, and it looks ready to go. So good call on that. Appreciate it. Nice. Good stream. Any final words of wisdom before we let them get out of there and enjoy the rest of the day and we prep for the Fed meeting?
Yeah. Enphase up 14%. You know, I thought Netflix too. And I thought the subscriber loss. I think they were looking for 2 million. It came in at 1 million. I mean, again, that's just. I hate to sound like a rah-rah all the time bull, but I just think the collective they want you to believe that the economy, the underlying consumers, in worse shape than they actually are, and I think that's putting people on the wrong side. Microsoft up 5%. Also, look at that. Bennett, do you have something ready on Microsoft? Microsoft and Google both up 5%. Holy cow!
Yeah, I actually covered Google last night on a YouTube video. Haven't done Microsoft.
Yeah, even just short-term little trend
I think
line
the thing I heard on Microsoft was in the guidance that better than expected web server report. So it's not always about the actual earnings miss. It's what they say is about to happen next, and so
100%.
The thing with Microsoft is Azure, the cloud services is it's such a high margin business. It's a smaller percent of their overall revenue, but it's a majority of their profits, and their profit margin increase. Their cloud services put pretty strong numbers out there, and that's why Microsoft has the premium valuation that it does. Because again, it's a high margin business. It contributes a lot to their bottom line, and those numbers were strong. Can't wait to see what Apple report says. That's going to be huge for me. I think that's going to be the ultimate report on how the consumer's doing. But I mean, what a strong rally we're seeing this morning. Meta is up 3.6, SMH up 2.8 today.
2.8. That's crazy.
That's amazing. Yep. You
heard it here first, guys.
Yeah. I hate to be a rah-rah cheerleader, but I don't know. You don't know. And all right, well, that's all I got from this end, but I appreciate you letting me join you guys.
Absolutely, man. Absolutely. All right. Hey, viewers, we appreciate you tuning in. Members, we'll see you in about 12 minutes for our weekly member webinar. Check us out anytime, tradinganalysis.com. If you did enjoy the content, please subscribe with notifications. Give it a thumbs up. Let the YouTube algorithm know. It'll help distribute it accordingly. And also, if you haven't had the chance, check out the 2 public videos I posted yesterday. We took a look at price action in Google following last night's miss, although guidance was certainly interesting along with Microsoft. So that's it. We'll be back same time, same place next week. Terry, Todd, appreciate it. And have a good one.
Have a good rest of the week, guys.
All right. Be safe. Viewers, we'll see you next week. Take care.